there's one last thing, right? Because when you have these discussions, the first thing that comes to mind is, wait, hold on a second. Are you telling me, like, I was thinking about adding a 5% position to this as my diversified alternative sleeves, right? I have this, I have private credit, I have my long short manager, I have a market neutral manager. What should I do with those? And I'm not opposed to having any one of those as an alpha overlay, especially if you can stack them. Okay, because you can. The thing about market neutral, for example, is that it's not designed to be a diversifier in periods of inflation or negative growth shocks. Right? It's designed to give you 200 to 300 basis points a year. So it's kind of like the cherry on top, right, of your cake, for example. I see it as that, where inflation's 10%, you're going to get 200 to 300 basis points, so negative 700 basis points of real return. You get deflation 400%, you're going to get 200 basis points. That's not going to change. The difference between those types of alts and CTAs and global macro is that you would expect them to do really outsized double-digit returns in both those prolonged periods of inflation and prolonged periods of bear markets, if history and the analysis that we've done is any indication. And so the last thing I'll say about alternatives that I try to point out, and I'll show here, is that the correlations of these alternatives, one of the biggest complaints about hedge funds is that they're not really hedging, right? Like they're supposed to be different, but they're quite similar. And I got to say that there is something to that. And just share my screen here quickly. There is something to that when we look at this slide, which I just grabbed the hedge fund indices in the HFRI database. We're looking at activist, equity hedge, market directional, event-driven, special sit, value arbitrage, absolute return, convertible, merger, and relative value, market neutral. And then the first line is the S&P, the correlation to the S&P. So we've ordered them, Corey and I, from most correlated to least correlated. And we do get, again, to the point where the only one that I see is lowly correlated enough to warrant it being called a hedge fund is the market neutral index. But again, that's not designed to be a pillar of portfolio construction. When we move into the CTA, SocGen CTA and macro risk premia, they're non-correlated to equities and non-correlated to fixed income, right? Which I think we've talked about throughout this podcast. The other two that are worth mentioning in terms of non-correlation is the currency index, though currency is already embedded in both the CTA and the global risk premia. And then the short bias index, that has the lowest correlation, but sadly it also has a persistent negative carry to it, right? So when you're considering your alt sleeve and you have a limit as to how much you can do, and you're worried about inflation and bear markets, I got to say, like, you got to think about booting the private equities and all the things that are just other ways of equity, and really beefing up your inflation protection and bear market protection. I mean, we got to think about it this way.
Yeah. Right? It's a function of the real estate, right? So you've got limited real estate. And what does that real estate? Yeah, portfolio real estate. And so what is that? What do you hope to achieve via the exposure to that portfolio real estate? And private equity is simply another asset class that does well in positive growth, benign inflation, and abundant liquidity. Yeah, it's equity. So it's not going to give you that shock absorption on the way down. So if you only have 5 to 10%, again, this is one of those really interesting pieces of portfolio construction. You need it to be non-correlated, and you need it to deliver outsized returns during that period. So things like long, short, or market neutral, they're going to do something, but they're not going to give you the outsized return that you need to contribute to the portfolio to offset the other poor performing asset classes in said portfolio. And so, right, real estate, as you think about the allocation mechanisms within your portfolio, have to be thought through on a case by case basis for the limits and restrictions that different asset owners have. And that's actually where I think that it really becomes important to have someone with some expertise to help walk you through that, because it's going to be a little bit uncomfortable too. And as I think you advocate, Rod, it's like you need 30%.
At
of an
least, right? Like
allocation.
you know us. We think about it from a risk parity perspective, and so there's more complexity there, right? If it were up to me, you'd have a massive bond position, a small equity position, and you know the right level of volatility in my multi-asset, so that I could have balance between the three pillars, right? Imagine three pistons in a motor, all being able to contribute the same amount of power, right? So there's ways that you need to, that if you're willing to have tracking error, you can think about it. But generally, like from a practical perspective, most people are so married to their 60/40 that what I'm begging them to consider is just pro rata that down and add that third piston in your motor. You absolutely need it and are missing it, and nothing else will do. Right, in terms of the characteristics and qualities that these tend to have in the biggest blind spots in 60 and 40.
Yeah. I mean, they could, in theory, just take their 60/40 portfolio, replace it with an allocation to NTSX for 2/3 of it. So now you're getting a full exposure to 60/40, and then take the rest of the capital and allocate it to trend funds too. Like there's a few ways to skin
There's a
this
few
cat.
ways to do it.